Hi, and welcome to this part 2 of explaining how to the liquidity budget indirect model. So we started by looking at the change in the stock of raw materials of Nordlys AS and found out that the liquidity effect of that change would be a positive 9,500, positive for the liquidity, the cash flow. So let's take a look at the change to work in progress. And here we need to take a look at what is it that a stock of work in progress, products of work in products, is really about. So what we can calculate is that there has been the cost of materials, the production materials have been used, but it is still not finished. Therefore, we take an average approach on the salaries, the wages that has been used in producing a, let's say, 50% finished item. So therefore, to calculate this, what we do is we say, so the equal sign, we go into the income statement and we find still the cost of materials because they have been used for that materials. And now we add a half of or 50% of the variable wage costs here in the income statement. So we take an average approach on what has been worked on so far in the products that are still in progress, okay? Still in progress. So I forgot to say we need to calculate the denominator here before we divide. And what we use to divide with is our assumption for the turnover ratio for work in progress, which in this case is 24. So we divide with 24. So this is the calculation. Now the work in progress shows that it began with 100,000. Now it has increased with 130,000. So if we take the change of the value at this account at the beginning of the year, the opening value, and subtract the end value, we will find that there is a negative consequence for the cash flow because we have now increased the value, the capital that is tied up in this stock. So stock of finished products, we do the same thing, but with stock of finished products, what we need to do is to add both the raw materials that we have used and the total of the wages that has been used to create this. So equal sign and bracket again into the income statement, find the total numbers for the cost of materials here. We add the wages that we have used to produce this and end the bracket. And then we divide. Let's find what is the turnover ratio. How many times a year do we turn over the stock of raw materials? In this case, that assumption is 20. So 195,750. I'm just checking with the numbers all the time. So we started with a value of 180 products at the end stock here that had a value of 180. Now the value has increased to 195 some. So yeah, I'm not sure why Excel is playing with me here. So that is again, and did it not work with me here? No, it did not. Sorry, it changed what I tried to calculate because my expectations to this change is that it would be a negative effect from a cash point of view because we have now increased the value of this. Let's take a look at the change into our accounts receivable. So what number in the income statement is linked to our customers that might not pay us in cash, but actually have some kind of payment agreement with us. And of course, what we're looking at here would be the turnover. Now it says here in the assumption that the proportion on sales on credit is 50%. So what we look at here is, again, we need to take the turnover, the total turnover. Now, here only half of the turnover is paid for in cash. Therefore, we take 50% of that turnover, and now we divide with the turnover ratio for accounts receivable, which is 6 in this case. So a slightly decrease from change in accounts receivable here. So I would expect now a positive effect on the cash flow. We have gathered more debt from our customers here, so they have paid back what they owe us. Yeah, so to speak. So supplier credit, when we take a look at that, the first thing we need to calculate in the numerator is the purchase on credit. Now, the purchase on credit, we need to take a look at what materials have we used so far, and then add whatever is left on stock. That makes sense, right? Whatever is left on stock of raw materials has to be added to the materials we have already used, and then we can divide with the accounts payable. So take a look at this. So in the nominator, what we do here, actually we need two brackets, all right? So we go over into the income statement. Again, let's see, how many materials have we used so far for the production we have sold? Well, the 2.3 million over here. To this we add, and now a new bracket, the change that is taking place on stock here. So the year-end value at the stock of raw materials was 155. Now we subtract what was already there at the beginning, because then we have now calculated what is left, and what is left must also have been purchased in this year. And now we end the two brackets here, and then we divide with the accounts payable, in this case 24 times, okay? And did I make any mistake? Yeah, I probably did, but nevertheless, Excel has corrected it for me. All right, so at the beginning of the year, I was able to owe my suppliers 102,000. Now I have paid back so much that I can now only owe them 96,000. The effect, looking from a cash point of view of that, now we are on the other side of the balance sheet, so now we start with the year-end value and we subtract the year begin value. The effect of paying back debt, looking from a cash point of view, is negative. All right, so now we take a look at the change into other short-term debt, and in this case we are just giving a fixed number. Over here in the budget assumptions, we are told that other short-term debt are 140, are expected to be 140. They can lay many assumptions behind this number, okay? So still, we are on the liability side, on the right side on the balance sheet here. So therefore, we start with the year end and we subtract the beginning of the year, the opening value. So being able to have more debt to our short-term liability somehow is positive for our cash flow. All right. So following the template, now we need to take a look at net interest costs, and we find that number in the income statement as well. So I put a little minus in front because over here in my income statement, my numbers are just listed numerically. So let me take a look at my income statement. Net interest cost here is 17,000. So that is 17,000 that I've subtract. So the liquidity effect from operations would be 477,815. So far, so good. So now investments in fixed assets. And here we take a look at what the company has planned to do of new investments. So we simply just get the assumptions. These are plans that the companies have made, and you will be told if you have a case what these numbers is about. So 25,000 for new investments. Payments on long-term debt. We also have a number that we are told as an assumption, 20,000 in this case. Dividend paid. Now we need to take a look at what has the company planned to pay in dividend to their owners. Now let's take a look into the balance sheet as well, and let's take a look at what we have of what we have of assumptions here in the estimated balance. And here it says 100,000. So what we write here, again negative because we are paying the dividend, and we is 100,000 minus 100,000, or we take the value in this cell. So now tax for the current year, again, equal sign, minus. Let's take a look into the income statement. What have you planned, or what do we know has been planned for taxes in the following year according to budget? In this case, 91,150, sorry. So this total year planned activities is expected to have a change to liquidity effect of 241,665. What we do now is to say, well, did we have some liquidity at the beginning of the year? So we find that account in the balance sheet, in the estimated balance sheet on the asset side. Now we can see that the liquid holdings for this company at the beginning of the year would have been 134,670. Enter. So now when we sum it up, we can see that the liquidity at the end of the year is expected to be 376,335. I know in the book it says 336. That is according to some adjustments into the decimals here. So basically, pick up the assumptions from the estimated balance sheets, use the assumptions from the income statement budget, calculate new values here, find the liquidity effect, sum it up together with the operating profit to find the liquidity effect. Next calculation is to find the investments, the payments, the etc., etc. Again, sum it up here in the in-between calculations. And here, liquidity at the end of the year, what liquidity effect is expected for the budget period, what did we have to begin with, and the liquidity at the end of the year is 376 and 335. In the next video, we're going to talk about the balance, because we have to use this year in the balance sheet to make everything in balance, and then we have made the total budget model. So this was it from the indirect model, liquidity budget. So the expected plans that the company have for the following period, and the expected consequences from a cash point of view. Thank you for watching.